left a jacket. Still need to trim that tailbone. Pop a pus spot on it.
Good morning, everyone, and welcome to NZ Funds Connects. I'm James Greger, Chief Investment Officer at NZ Funds, and every week we're taking the opportunity to bring you a variety of perspectives on financial markets, financial advice, and developments here at NZ Funds. It is Monday, 6th of December at 9 a.m. We remain strongly of the view that a well-diversified portfolio which contains assets which profit with rising inflation and interest rates will be more resilient through the business cycle. But I think, as you all know, NZ Funds clients in the last few months have suffered from volatility and difficult performance. So today we're going to take a bit of a longer look at what's going on in the portfolios, what caused the volatility, and Mark and Andrew are going to go through specific asset classes in detail to give you some more insights. And then we'll have a summary at the end around Omicron and what we think the effects are going into the end of the year, because the volatility in different asset classes, perhaps than what we're going to talk about, could start appearing and have started appearing in the last couple of days. So what have we done and what's going on? From the 1st of April onwards, positions within portfolios became more volatile. The volatility led to most portfolios giving up the strong gains that we generated earlier in the year. So while we have given up the strong gains that we generated earlier in the year, we have retained the capital gain over the index for 2020. So to align the portfolios more closely to the benchmark for the remainder of the year and for 2022, we have substantially reduced volatility and position sizing. But what we haven't done is move away from our philosophy around generating returns from different asset classes. What does this mean? Well, we still believe that over the long term, commodities play an important part of a portfolio especially going into an inflationary environment. But there are different ways we can get access to those commodities, and one of them is using options. So while options do increase and decrease in value, you do have a limited downside when you invest in an option, but still participate in the upside should the price get there. Now, it's not just us that we think commodities are well placed for the remainder of this year and next year once this Omicron volatility passes. Big investment banks such as Goldman Sachs thinks commodities in general have a 30% upside. Given the overreaction of what's going on with the prices at the moment, but also the demand and supply imbalances that we've discussed throughout this year will carry on into next year. So entering December, we will be more closely aligned with the index. That does mean, though, there is a sell-off in shares in volatility markets. We will sell too, but we will be more aligned with what's going on. We will have active positions in the commodity options like we've been discussing, in rising interest rates, and Mark's going to touch on that a bit later, and in digital assets, which we think long-term will remain a great return generator that is differentiated from the share markets and what's going on in shares. Last but not least, within the portfolios, we will continue to focus on identifying companies with strong growth profiles and balance sheets. Because don't forget, although we do invest within other asset classes like commodities and digital assets, the core of our portfolios in the growth and inflation category are still shares, and the research we do within those different markets is still going to be the main driver of returns. Andrew's going to touch on a bit of the differentiation in returns across different parts of the share market, because at the moment you might look at the broader index returns and think things are volatile but not too bad. But if you open the hood of what's going on in share markets, there's definitely a divergence in performance and returns. Before I hand over to Mark to talk about interest rates, the last thing I wanted to talk about is downside mitigation, and I got some great questions over the weekend around our downside mitigation. Downside mitigation is an important part of the New Zealand Fund's investment strategy, and we have actually increased our exposure to downside mitigation through put options within the portfolios, but also through increasing our exposure to Universa, our downside mitigation manager. But the key aspect of downside mitigation is for share market sell-off. So if the share market falls significantly, like it did in March 2020, that is when our downside mitigation managers start generating strong returns. There are no downside mitigation aspects to commodities or digital assets. The way that we manage that risk is by investing in very liquid asset classes and exiting the position as those prices reach certain points where we think we need to take risk off, which is what's happened in the last couple of months. So downside mitigation, we will touch on this in more detail early in the new year and get our downside mitigation manager onto NZ Funds Connect to talk through it. But to be really clear, the downside mitigation is based on drawdowns of share markets. So let's touch on and spend the rest of the 50 minutes this morning going through each of the asset classes and what's going on, what's happened, and also what we think is going to happen over the next few months given the volatility increases in markets recently. So Mark, November was a difficult month. December has also started pretty difficult in the sense of what's going on with Omicron. Do you want to give us an overview of what's happened with interest rates and then perhaps how we think we should be positioned going forward?
Yeah, sure. Thanks, James. Good morning, everyone. Yeah, certainly November was a decidedly difficult period for the income portfolios, with the portfolios broadly down about 5%, which is one of the worst monthly performances we've experienced. And really that's a reflection of international fixed income markets and sort of seeing a lot of volatility despite sort of plenty of evidence that sort of reinforces the views that we've talked about a lot around inflation and the necessary path of sort of interest rates in the US to get higher. But each time you sort of had, I suppose, the path of interest rates, really we've had interest rates move higher over the month, but each time they've moved higher, that hasn't been sustainable and they've sort of given up those gains pretty quickly. So over the last 6 weeks, we've sort of seen the benchmark 10-year US rate move, hit its highs in October, moved down after that relatively quickly by 30 basis points, regain the highs, and then move down again by sort of 30 or 40 basis points to where we sit today. So really over a 6-week period, you'd have had sort of total cumulative range of sort of over 1%, which is certainly not the highest we've ever seen, but certainly getting up there in terms of volatility for that space. And that's really the key aspect that sort of hurt us. And in reflection, we've been whipsawed because we've had those positive views, and those views have been reinforced by the data, but the market action has not supported that. What is interesting now, and is really we've seen as we sort of enter December, quite a significant pivot from the Federal Reserve. You remember going back really only, I suppose, to middle of early November, lots of discussion about the Fed tapering their bond purchases. And that was very well signalled, and they talked about tapering. And then in November, they actually said they would look to begin the taper in December and do that over a 6-month period. What we've seen since then is actually quite an aggressive move from them to sort of suggest that that taper has to happen much quicker. And the expectation is that will now happen by March, and that they need to be in a position to actually be able to begin to tighten financial conditions much earlier than people expected. And this is, I suppose, ultimately that sort of signal that we've sort of said for some time that we are in a transition period for interest rates. We've had a period of ultra low interest rates, but they really need to return to a more normal 2 to 3% range around the world, rather than the sort of sub 1 or 1% type region, which they have been, and they sort of are still hanging around in terms of many markets. But despite that, given the news of the Omicron variant, we're very much trapped near the recent lows in terms of markets. And if I step back and think about sort of the past 3 major interest rates rising or tightening cycles, that was sort of 1994 was a big one. Then you saw post the dot-com bubble in 2004 and 2003, 2006. And then more recently, sort of 2016 through 2018, you sort of saw, I suppose, interest rate rises were driven, or the moves in the market were highly correlated to expectations around Fed policy, the timing or the time to their next hike, and medium-term growth and inflation expectations. And they were the key drivers. And if we sit here, sort of looking through this morning, a number of economics expectations, still there are strong expectations that Q4 GDP in the US will actually be, in fact, they're being increased. A number of people are sort of in the range of 7 to 9% annualized for the quarter, which leaves total 2021 growth in the US at a remarkably strong 6%. However, market pricing really suggests that in 22 we're going to see a very sharp slowdown in growth. Now, there is an Omicron scenario where that could eventuate, but at this point we don't sort of see that as our central situation. Despite that, in terms of positioning, we've taken a lot of positioning off. I think we've got to acknowledge that the outlook for risk assets is challenging if we are seeing interest rates rise and we're seeing concerns about the virus. So what we have done is very much focused any sort of short positions we have on the very short part of the curve that's most impacted by Fed actions. And as we move further along the curve, to ones that are more forward-looking, areas that are more forward-looking in terms of interest rates, we have started to add long positions in those portfolios. So if we do see a market start to aggressively weaken in terms of, say, share market, those positions should benefit. The other one we have got in the portfolios, we have in the income portfolios, we've tended to be under-hedged on the New Zealand dollar, and certainly New Zealand dollar being a risk asset has generally is pretty challenged at present and has moved back from, I suppose, 72 cents in that region in sort of early November, back to sort of 67.5 here today, and it looks like it's under a bit of pressure over the shorter term. In terms of domestically, I think that the New Zealand situation is very different. I put the chart in the paper this week just to sort of demonstrate how the interest rate cycles have diverged. when I talk about that sort of transition to a sort of higher level of interest rates, very much that has happened in New Zealand, and you can sort of see in the chart there was a very aggressive move in sort of the middle of this year higher in terms of interest rates, and we are sitting in that sort of 2.5% type area for most of the New Zealand interest rate curve, and really that sort of says that the market has priced in the Reserve Bank actions. The Reserve Bank has moved twice already, and they're levels which we think are actually pretty attractive to own, and we do own them in the portfolio. We've been adding interest rate positions to the New Zealand portfolio, so the Australasian focused portfolio. So it means that portfolio is well placed if we do sort of see further stress in share markets and risk assets. You would expect those positions to do quite well. So I probably will sort of leave it there, but generally sort of have, I think the theme is we've reduced position sizes, still continue to expect interest rates at the shorter end of the curve to move higher offshore. The longer end of the curve, sort of 10 years, etc., is going to be more determined by what happens with wider risk assets. And in New Zealand, we think it's a good place to invest at this point in time.
Mike, do you want to just touch on quickly credit spreads and the actual fundamentals of underlying companies that you invest in from the bond perspective, and talk about what's happening in that part of the market?
Yeah, well, I think, again, you need to separate it probably to two parts. The true credit risk component, and generally, given what we've seen in terms of the bounce, well, no, not the bounce, the strong economic activity that we've had, and ultra-low funding levels, most corporates around the place have very good balance sheets, maybe carrying a little more leverage than they did a year or two. But typically generally they've issued bonds, fixed rate bonds at very low levels, so they have very little need of refunding that. And at the same time, the underlying businesses are strong. So I think, I can't remember the number off the top of my head, but I think last year is the lowest level of high yield defaults, or this year, were the lowest level of high yield defaults really since the GFC. So it's a very robust picture from that point of view. Against that, though, credit spreads, the price of credit is relatively high. In terms of, say, the investment grade index in the US, that's sort of trading at about 58 basis points. The low was 45. And if we look back to, say, the extremes of March last year, there was 150 basis points. So we're still very much at the tighter end of that. And within the global portfolio, I have looked to actually start to add a degree of protection against those widening. I wouldn't expect a large move wider, but I think, given where prices are, if we do see share markets come off further, we'd expect that pricing, like everything else, to sort of move to maybe a more normal level of sort of 75 or 80 basis points. So we have looked to, at the margin, provide a little bit of protection against that happening. But again, I think, probably the other aspect, and I don't want to talk too long, but one of the themes we've had in the portfolios generally is to have high levels of cash. That's been really around the view that we felt credit prices were too low. And I think in the high yield space in the US, you've seen over the last sort of 6 weeks, really credit spreads have moved out significantly. Again, still below their average levels, but they really have moved out and are now wider on the year. So that does reinforce our position to have held cash, and actually leaves us in a pretty good position to be able to start to add positions into any weakness that we see sort of going forward.
Mike, the last thing I wanted to touch on the income portfolios is, as the interest rates came down sort of quite dramatically through end of November, that generates negative performance if you have positions like we had. And so sometimes it begs the question of why were you trying to manage interest rate risk? If you did nothing in the portfolio and didn't manage the interest rate risk, and interest rates went from, I don't know, in the 5-year from 1% to 1.8%, what would that cause in the portfolios in terms of that also causes negative performance? So you can't have it both ways. If you do nothing, you're going to generate negative performance as interest rates increase.
Yeah, I think again it's about that degree of volatility in interest rates themselves. If we have a period of where interest rates move higher slowly, it tends to get any negative capital impact gets sort of mitigated by the coupon you receive. And mid-league coupons are pretty low at present. But again, the rule of thumb is that you multiply any interest rate change to work out the capital move. You multiply any interest rate change by the maturity of that asset. So in the extreme, if you have a 10-year bond, in your example, I think you moved interest rates up by 80 basis points. You multiply that 80 basis points by the number of years maturity of your bond. So you multiply that by 10. So that would suggest that your price has gone down by 8% over that, given that move. So exactly, that's something, and ultimately that's the key reason why we do have short positions in the portfolio. Frankly, they haven't worked at this point, and certainly for those who have entered over the last 6 months, those have been here for a longer period, and as you sort of said at the intro, had a very good first quarter, but that's really been, we've very much given that away over the last 6 months, and that's particularly, we need to acknowledge that's particularly challenging for clients who joined us recently. But we're still confident that we can position the portfolios appropriately for the environments that we're facing and can generate returns going forward.
Great, thanks, Mark. Moving on to growth, Andrew, and inflation and the volatility around those parts of the portfolio. Look, I think it's, you look at what's going on now with just general risk off, but perhaps we can touch on the specific positions around decarbonisation and energy commodities and discuss what's going on in those asset classes.
Sure.
And the share market, obviously.
Why don't I start with the share market, given that's the asset class people probably observe the most in the media and following the markets. So November, as a start, was a little bit weak through most of the month, but really where things started to get more volatile was towards the end, and this was on the back of Omicron, which hit on a Friday a week ago, and the market went into quite a panic mode very, very fast. So basically treating this as sort of a potentially more scary version of Delta. We're gonna speak on Omicron a little bit later, so I won't go into too much more detail. But just safe to say it was sort of a catalyst for a big risk off in equity markets. And what we've seen is the S&P 500, being the global bellwether index, has come off about 4%, which in of itself doesn't seem too bad. But the fact is, S&P has been more resilient than most other indices around the world. And to give you a little bit of context for this, the Russell 2000, which is full of smaller and mid-cap companies in the US, has come off by about 8% over the same period, but it actually started selling off a week or so earlier before the S&P and has sold off 12% in total. And just to sort of give you this, I'll try to get this in a picture for you. So the chart I've got up here is comparing the S&P 500, the Russell 2000, and the NZX 50. And so the 4% move in the S&P is this white line here, which has dropped down. And so, that's a sizable move. We've only seen about 3 or 4 occasions where the S&P sold off 4 or 5% this year. So decent move, but nothing particularly out of the ordinary. Yet if we look at this blue line, the Russell 2000, that sold off by about 12%, and it started selling off more around mid-November. Now, if we compare it to the NZX 50, NZX 50 has taken a similar sort of dive down to the Russell, although not as bad, but it actually started weakening a little bit earlier in October, and so far we've seen a total pullback in the NZX 50 of about 5%. And so I guess that sort of raises the question of what's going on, why we're seeing these different moves across different indices. And so what the market's doing at the moment is largely having a risk-off type attitude, and that means they're selling companies that they perceive to have higher risk. And so your higher risk companies are often the companies that are trading at the most expensive valuations. And so a classic subsector of high valuations is technology stocks. Technology stocks tend to trade at very high PE multiples, or many of these companies aren't even profitable at all with no cash flows. So you have to price them on an enterprise value to sales multiple. And when the market is really anti-risk, they often sell these businesses because basically they've got less support and they don't have underlying cash flows that are going to support the valuations of the companies. Over the same period, we're seeing these type of technology stocks, these sort of smaller, more growthy type ones, have sold off between 25 to 30%, which is a really big move. That is the sharpest sell-off we've seen since March last year in these types of companies. And even some larger companies, Tesla's sold off close to 20%. Facebook's had a decent sell-off. There's been a few, but then on the flip side, there's been some other technology companies which have done relatively well, and that's some of the ones that are considered the more safe ones, such as Apple, Microsoft, Amazon have held up a little bit better. Other sectors we're seeing sell off quite hard are any sectors that's sort of also considered higher risk, and that's ones that are more cyclical in nature, or they have more cash flows tied to commodities, and we're seeing decent pullbacks in these companies too. And so you might ask what companies have been performing well. Well, the obvious one are the vaccine companies. I think Moderna's up 40 or 50%, which is a US pharmaceutical company that produces one of the main vaccines there. Some sectors of healthcare have done relatively well, though generally still negative. And some of the other defensive type sectors have held up relatively well, although also generally still negative over the last few weeks. So that's companies like telecom companies, some segments of utility businesses. So in general, it's been a very volatile week and a half in equity markets, and you just don't really get the proper picture of what's going on by looking at the headline S&P 500. It's really the subsectors within it which are doing a lot of churning. So with that sort of context on share markets, I might jump over to energy commodities. We're seeing similar volatility in energy commodities, and I'm going to break this down into both natural gas and into heating oil, because that's the two energy commodity exposures that we have. In November, for natural gas, it was really a very poor month. Natural gas overall fell down about 17%. Within this, there was periods up, periods and down periods. There's relatively volatile, which is what you typically see in these shoulder seasons before it gets into proper winter. The reason natural gas came back was the weather in the United States was warmer in November than was expected, so slightly warmer than average. And what this meant was that they didn't draw down on as much gas as the average would expect, and so basically it meant they were able to build their storage levels a little bit higher. So their storage levels are still below what would be considered average levels, yet the pressure has eased off a little bit. So the concern in the United States, at least, of a wide-scale gas shortage has decreased significantly. So that's why United States gas prices come back by about 17%. Now, I just want to jump over to Europe a little bit, because the Europe situation is also heavily tied to what's going on in the US, and the European situation is not eased at all. So the gas levels there are still very low. The weather in Europe is actually been colder than it has in the United States. There's been decent draw levels on the gas storage, and that's why the European gas prices remained very high. Now, what this means is that there's still an ability, a very strong incentive for European gas, so US gas producers, to export their gas to Europe to help ease the situation. And that is still going on, and they're making a very large profit doing that. Yet the problem at the moment on the gas trade is that the warmer weather is sort of winning the fight at the moment, and it is making people more relaxed on the situation in the US. So overall, that's had a negative consequence on our portfolios. We've lost in November. This would have been the number one driver of our negative performance. And even though we lost money on equities because global share markets are down, the gas was the more significant portion of the loss, with the 17% move down. So we have responded aggressively. We've cut our entire futures position in gas. If you remember, we used to hold our exposure in gas in two parts. One was long natural gas futures contracts, and the second one was options, where we had some call options that give us upside on natural gas. So what we've done to manage the risk is cut our entire futures position. Now this it gets a little bit complicated when I try and give you a percentage of how much of our exposure it is, because options it depends whether you're looking at the upside value of the options or the current market value of options. But just to give you a little bit of an idea, where we've cut well over half of our total exposure in terms of risk. And so we're now just left with the options. What the options mean is that we know exactly how much more risk we can lose. So if the gas price stays where it is and doesn't go up or falls more, we know exactly how much money we will lose from the options. It doesn't mean we're out of this trade. We still have huge upside from these options. So if natural gas starts to tighten again, the price ends up again, and we see some due to cold weather in the United States, and there's still really big upside from this trade. But we think it's prudent at the moment to manage risk, given what's been happening with the price action, and so we're now more comfortable with this risk level. Just jumping over to heating oil. So the heating oil dynamic was a little bit different to natural gas. Again, heating oil also had a weak period in November, yet most of that weakness was right at the end when Omicron variant came onto the scene. And so when on the Friday, a week and a half ago, when Omicron first made global headlines, oil price, the crude oil price in the US was down by about 13 or 14% in one day. I think that was the fifth or sixth biggest one-day negative move in oil in history. So it was a very, very sharp pullback, and that's basically driven by concerns that there's going to be widespread lockdowns. So obviously, if airline travel stops, people stop driving as much because they're in lockdown, and the demand for oil decreases. Now, heating oil is heavily linked to the price of crude oil because it's a distillate of crude oil, and so we basically saw a similar movement down in heating oil. Due to our risk levels being triggered throughout November, and not just from heating oil, just because gas, that means we were reducing risk in other trades as well. So we'd actually taken off a very large portion of our heating oil exposure before we saw this negative 14 or 15% move. So we decreased the downside loss from this significantly, yet we still had some exposure on, so we still saw some negative consequences. So where we've got to in heating oil now is we've done exactly what we've done with natural gas. We've taken the entire futures position off. There's actually some small long futures on in heating oil, but we've got short crude oil futures against it, so we've hedged that position out to zero exposure, and we're left with our options in heating oil. So in the same way with natural gas, we've got call options, which will give us really nice upside in heating oil if it plays out, but we've just reduced our risk level significantly.
Andrew, it's interesting on the oil sort of dynamic at the moment, where basically where the oil price has gone, there's an assumption, there's different ways you can try and put metrics around how much it's fallen. And some of the analysis coming out of the people that we speak to is basically it's assuming Omicron is going to cause zero flights in the US for 3 months or something like that. I mean, it's a huge assumption that of the demand degradation that may not come to fruition, and if it doesn't, then we've got big supply-demand imbalances that you could see a real retracement back up of those prices.
That's exactly right, James. I think roughly the price movement in oil is assuming between 4 to 5 million barrels a day of demand destruction for oil. That's roughly 4 or 5% of world demand over a period of about 6 months, which is a massive decrease, and it seems more like this is really reflective of a risk-off movement and fear and concern rather than actually being able to attach it to fundamentals. And that's why we're still we've hedged out all our heating oil exposure by shorting crude oil, but we could bring that on quite quickly once things settle down, or if they do settle down. We're not going to add the risk back on if there's no reason. But let's, for example, say it comes out next week that Omicron, they confirm that Omicron has more mild symptoms. It's not resulting in hospitalizations. There's not going to be wide-scale lockdowns. If that happen, we'll expect to see a very fast bounce back in heating oil and crude oil, because the reality is the world is in quite a tight spot when it comes to crude oil. There's been a lack of investment over the last 2 years. There's been supply chain constraints, and the world economy, even though it's been bumpy, has been recovering really fast, and demand is coming back strong. So the situation remains really tight, but for now it's not dominated by the fundamentals. It's dominated by the risk environment, the fear of what could come with Omicron. Should we move on to uranium, James, or is there anything else you want to touch on?
No, I think we covered that pretty well. Let's move to uranium, which is quite idiosyncratic, as you've been talking about. It's it's all linked in a risk-off trade. People just take risk where they need to, despite the fundamentals.
Yeah, well, that's right. Well, actually, the underlying commodity of uranium is held up really well. So most commodities are sold off by a decent amount over the last 2 or 3 weeks, because in the end, commodities is a risk asset. In the same way as where global risk heightens, you expect equities to sell off, you tend to see most commodities sell off. Uranium's actually held up relatively well. That's the uranium spot price that's been traded on the daily market. And I think that's because uranium's not really that linked to kind of short-term demand factors. Uranium is a very long cycle commodity. It is linked to the amount of nuclear power generation going on around the world. So unlike oil, where you can get like an Omicron variant go around and all of a sudden your demand for oil drops significantly, that doesn't happen with uranium. Uranium's demand is very sort of consistent and increases over time as the need and demand for nuclear energy is increasing. Yet what we have seen in uranium is that the uranium mining equities has sold off relatively significantly over the last 2 weeks, and that's because the risk uranium equities are kind of considered a risk asset within equity. So the same way I said high valuation technology companies are sold off because they're considered riskier, basically any commodity linked share is considered risky too, and so they've been sold off. And so we've seen some of the companies come back by about 20% or 25%. We've trimmed some of the exposure to these companies just because we want to protect further downside, but really this is not related to anything fundamental, and it's just a risk off. So it's unfortunate you get these moves, but that's the reality of investing in some of these segments and equities, in the same way that we've made about 50% of some of these positions since we started the trade, and we made that very fast. It happened in the period of about 4 to 6 weeks. We've now given up about 20 or 25% in some of these positions. So in general, we're still significantly under profit since we took these uranium mining positions, but unfortunately over the last couple of weeks it's taken a relatively large hit. So we've decreased exposure to the largest and most liquid uranium mining equity out there, which is Cameco, which is a large listed Canadian producer, second largest producer of uranium in the world, and has a very liquid share market. So we've cut some risk on that position there to decrease it. But we're not looking to exit this uranium trade at all. We think the long-term demand is still really positive, and as soon as we get through this period of riskiness in the equity markets, we would expect to see these companies bounce back. In fact, a lot of people using this as a good buying opportunity to add these positions, but as we said, we're not looking to add risk at the moment, so we're certainly not buying. We're just going to have to take our time on it.
I think that's a really good point around what we try and balance in the investment team between short-term meaning can mean 12 months, short-term volatility, and our long-term thesis around some of the investments within the portfolios. So if we thought 5 years out, Andrew would be as the key sort of instigator of finding some of these really interesting companies. It would be saying this is a buying opportunity. These companies are really cheap in comparison to where we think that they're going to go. At the same time, Andrew, you're probably sitting there thinking, well, in the very short term, we don't need the volatility. We've already had significant volatility because of other asset classes, and so we have to balance that. But this is the constant, portfolio manager dilemma you've got between short-term volatility and long-term prospects. And as you pointed out, we're really positive long-term about most of these positions. If we weren't, we wouldn't be invested. But we have to think about the short-term volatility because that's the nature of investing, especially when we can follow portfolios on a daily basis. We have to be cognizant of that. So it's a good point.
That's exactly right. Yeah, the problem is I think these are great buying opportunities here, but if the S&P falls another 2 or 3 or 4%, we'll likely see uranium equities down. So we just need to bide our time, get through this period of volatility. If the Omicron concerns over Omicron start to ease because of the virus not being as bad as they thought, then there'll be a great point to add. But the reality is at the moment, the risk and uncertainty in equity markets is too high, so we need to just bide our time.
Then what's next on your list?
Digital assets would be the last one from me. So yeah, it was actually interesting when I when we were as a team writing this on Thursday afternoon, New Zealand time, we talked about crypto assets have been relatively resilient so far in this period of volatility. And so even though Bitcoin has fallen from its highs that it had in early November of $68,000, so I'm sure if people were following it relatively closely, Bitcoin finally broke through the highs that it hit about 3 or 4 months before. It peaked out at about $68,000, and then it had given up about 6 to 10% of that or so over the next week or two. Ethereum, on the other hand, also had a high and it hit $4,800 also in early November, and it also retraced from that level of about 4,800 to around about 4,300, give or take around that area. But even though there'd been a pullback in crypto assets, it wasn't a very sharp pullback. It was relatively orderly. We'd taken some opportunity to reduce our exposure to Bitcoin because we tend to follow the momentum in cryptocurrency very closely. And as soon as we see things start to peak out a little bit or look like it's losing momentum, we tend to take some profits. And so when we were writing this on Thursday last week, we were commenting and writing about the share market volatility, the commodity volatility, but was surprised to see that cryptocurrencies were still trading relatively well. And so this was obviously a good thing, but we noted that this could be, given the risk-off environment, we may start to see some weakness in crypto assets. So a little bit, we know 24 hours later, this did happen. So over the weekend, there was a relatively material sell-off in Bitcoin and Ethereum. Bitcoin sold from around about $58,000 down to the low $40,000. It's since then bounced back and traded at $49,000 currently, but it's still 10 to 15% below where it was 2 or 3 days ago. Ethereum, on the other hand, although it had a really big sell-off over the weekend, has bounced back to about $4,200 and is trading around about where it was prior to the weekend. So it's made all its gains back. Now, what people are sort of saying has happened in cryptocurrency over the weekend is that there is a risk-off sentiment in general, which is we're seeing in the equities and commodities. This flowed into the cryptocurrency space. There were a number of sell orders out there, and then it basically triggered a bunch of stop losses or points where various institutional investors need to sell positions. And what sometimes happens is all of these get triggered at once, and it causes just a massive wave of selling orders to come into the market. And that's why you start to see sometimes moves down 20%, down 25%. What tends to happen after that is that these orders get cleared, and then the people who want to buy and are value-focused investors come through and buy them, and that's why you see some relatively sharp bounce backs. And so, in terms of how this has impacted us, we have reduced or removed essentially all of our Bitcoin exposure, and we had done that prior to this move over the weekend. So we've been reducing Bitcoin over the last 2 or 3 weeks. Which is what I wrote in the note that we wrote on Thursday. And so we managed to avoid most losses related to Bitcoin. We've got most of our direct cryptocurrency exposure in Ethereum at the moment. And that's been a move that we started to do right the way back in April or so this year, where we put out an investment insight note about why we like Ethereum and the potential for Ethereum over time to become the biggest cryptocurrency and overtake Bitcoin. And we've retained that increased exposure to Ethereum right through that period. So, so a long exposure to Ethereum, we've managed to escape losses on that over the weekend because it's bounced right back. But where we think we will have more negative impact from Bitcoin is in Galaxy Digital, because Galaxy Digital, even though it's not a Bitcoin specific player, it's a diversified cryptocurrency player. Its price tends to be heavily linked to Bitcoin's price, and so Galaxy Digital has sold off relative material over the last few days, and that was a mix of general cryptocurrency weakness over the last 3 weeks, but also just the share market weakness and the fact that all technology growth companies and riskier equities were selling off, and Galaxy was not immune to that as well. So we'll see what happens this week. I guess given what's happened with Bitcoin over the weekend and it's still down, we may see some more weakness in Galaxy Digital. And again, that is also a position where we have been reducing some risk over time as well, but we still have a relatively decent exposure. So unfortunately, we're not immune to the cryptocurrency sell-off, but we have significantly decreased any downside by the fact that we took off our Bitcoin direct exposure and we've been rotated into Ethereum.
And I think again, similar to the uranium, the short-term volatility, when we think about our views around what's going on in that asset class over the long term, These aren't our numbers, these are Goldman Sachs, but Goldman's is sort of talking an Ethereum price of $80,000 over the next 5 years or something, and Bitcoin reaching 100,000. Now there's a lot of water to go under the bridge to reach those levels, but I guess the sentiment around these asset classes are here to stay is certainly sound, and when you have these risk-off moments, it's opportunity to buy back in or not panic, knowing that in the short term this happens, but over the longer term things do recover because of just the weight and momentum of people buying into these asset classes. So I think we Bitcoin is one that we've been a bit more concerned in recently because of its reaction function to what the Fed's doing. Higher interest rates means potentially, they fight inflation, and that's got some negative attributes to the Bitcoin price in the short term. Ethereum is a technology company, essentially, and we're really excited about what that's going to be doing. And if you're in any doubt of what some of the uses that Ethereum are going to be if it's going to be prevalent in the world as we know it and how we work, just go to any 10-year-old's house in the weekend and see what they're doing on Fortnite and all these gaming systems where they're trading with their friends using tokens, and essentially kids are already doing it. It's taking the adults a little bit longer to trade tokens, but essentially the world is moving to that place, and the attributes that Ethereum have are just really exciting. So it hasn't, the volatility doesn't make us nervous. That makes us, actually gives us opportunities to think about are these times where we can buy back in. But things are volatile at the moment in that space, but it's not something that there's going to be a lot of told you so type of people and when Bitcoin gets volatile. But we think that's just a lazy way of saying they don't understand the asset class. Andrew, anything else that you've got on the growth and inflation portfolios?
No, in terms of major positions, I've covered them all. So just to recap, it's natural gas weakness, heating oil weakness were two of the main contributors to the November performance. And then there's the general share markets, even though we've significantly reduced our share market exposure, which maybe I didn't touch on before, but we've been reducing share market exposure more or less over the last 6 weeks. We wrote Investment Insight at one stage where we talked about the risk to equity markets, and at that point we're focused on the fact that the Federal Reserve in the US was starting to get close to the point of tightening, which to us meant that the risk of an equity markets pullback increased. So basically across all our growth portfolios and inflation portfolios, we reduced equity risk. However, we still had good equity positions, still sort of roughly in line with the market. So when you get the S&P pulling back 4% and you have the Russell 2000 pull back 12% and the NZX 50s pulled back by 5%, that's obviously still going to impact our portfolios. And then, lastly, as I touched on, digital assets and cryptocurrencies was probably the fourth largest contributor to negative weakness, but this wasn't one of the more material ones. So outside of that, the other positions are all smaller, so such as Australian positions, which we're really large enough movers to touch on today.
Thanks, Andrew. So I think we've hopefully given some really detailed, and we try to get into as much detail as possible on these positions to really give some colour about what's going on. And I guess one of the key questions that is going to come back was, well, why do we invest like this? Why are we investing in these different asset classes when the S&P's relatively stable, and we think it's wouldn't it be a simpler portfolio with less volatility if we focused on sort of index investing? And it really goes back to what our view is over a longer term horizon, where we think that investing in the market in a 60-40 portfolio over the long term really isn't going to cut it. We're going through this paradigm shift of interest rates, a paradigm shift of inflation, and we think over the long term, those two things will really cause some serious issues for just a standard 60-40 portfolio. Now, it hasn't worked the way that we had hoped it since April. Absolutely acknowledge that. The volatility has been really disappointing, especially for those clients that have joined in the latter parts of this year. But when we really think about long-term investing and the drawdowns that we've had in the past, these times do pass. We've got positions within the portfolio that have significant upside within the growth and inflation portfolios as those themes come through, as these paradigm shifts start to get more momentum in the way that we think they will happen, rather than the chopping and changing and different data points that come out. We think the performance and the returns that we can generate within those categories are really, really strong. At the same time, within the income portfolios, if we do get a sustained increase in interest rates, a standard indexed bond portfolio will have significant negative returns. Significant. And we really think it's important, given the magnitude of what interest rates can do in terms of their momentum upwards, need to be managed. And if they're not, and you have what's happened at the moment, you look pretty good, and we look like we're out of kilter with what's going on. But we think over the longer term, with inflation printing at 6% in New Zealand and 6% in the US, overall interest rates will track up significantly in the context of where they are now, and that's going to cause serious stress on your standard indexed portfolios. So where to from here? We have to be patient. For clients that have been and advisors who have been taken aback by the volatility, we have taken a lot of risk off, as Andrew and Mark have talked about, but we still remain invested in a lot of those positions to benefit from the upside as those positions come through. And I guess at that point, if it's something that the volatility is not something that clients want to continue to participate with, then on a KiwiSaver context, we've got portfolios that do track the index in our balanced KiwiSaver fund, which is just tracking the index, and that won't have the volatility of our positioning. It will of the market. So if you get market sell-offs, it will go up and down with that. And from a more advised portfolio service type of clients, then if the volatility can be managed through asset allocation and having different allocations to different asset classes, and I really encourage everybody who are concerned about it to have a think about the type of portfolio that they have. And given we're going to see likely more volatility in markets because of Omicron, that's a good opportunity to talk about it. What's our view, though? Our view is if you're a long-term investor, and that is sort of 5, 10, 20 years of investing, these are the types of scenarios where you just have to acknowledge what's going on and try and look through it, because we think overall that the performance that we can generate in investing like this is going to be superior, and that's why we do it. And it hurts in the short term when you look over the fence and see your index investors doing okay, but we think over the longer term, this is the way that we think we can manage risk and generate returns in an environment that's going through huge structural changes. So I hope that was helpful. Mark, Andrew, really appreciate you diving into those positions and talking through them as openly and candidly as you did. If anybody has any further follow-up questions, please do get in touch. Obviously, we've had a lot of specific questions around different assets and what's going on, and so we've tried to do our best in answering those. But if anybody has any more that I'd like to go through, then do let us know, and we'll do our best to get back to you. Otherwise, we remain.
And so, we didn't touch on, just before you wrap it up, we didn't touch on our outlook for Omicron. Do we want to just 2 minutes on that, or running out of time?
Yeah, why don't we go? I was going to say we're about to look into an interesting end of the year, so that's perhaps a good segue into 3 minutes on Omicron, Andrew.
I'll try to do it in 2 minutes, so I don't take too long. We're running out of time. But we're looking at Omicron from a overall investment market risk perspective. We break it down into 3 factors, and this is nothing particularly new. I think you would have read about this in the media over the last week or so. So the first area we look at is virus transmissibility, and so how contagious is the variant, and therefore how fast will it spread. Early indications out of South Africa and largely agreed by virus. The second one is virus severity. So how likely is this virus going to put you in hospital? How likely is it that you'll need to have breathing support? And what is the potential death rate from people infected with this virus? So far, this is uncertain. There's mixed reports coming out. There are some reports out of South Africa saying it seems to be mild symptoms. Other reports are saying that it's mostly younger people, therefore the symptoms are going to be mild, or it's vaccinated people getting mild symptoms. And we think it is too early at this stage to make a conclusion on this, and the experts we've spoken to has said it's too early as well. The last point is virus vaccine effectiveness, and so this what we're really looking to see here is that the current vaccines in circulation maintain effectiveness of around about above 90%. As you start to get significantly below 90%, this means that the level of protection is starting to get low on a global population basis that will allow this virus to spread and still have significant harm on people that may be vaccinated. And this will mean that you need to get an adapted vaccine, which will need to come out to give people a booster shot to protect against Omicron. Now, it will take pretty much all the global vaccine companies over 100 days to research, tailor their existing vaccine and produce it out into the market. And if we're talking about 100 days from now, it's probably realistically at least towards June or July next year that you start to get material portions of the population vaccinated.
We just did 100 days of lockdown in Auckland, so that 100 days is a long time. It's a long time. It's and I guess
it's a long time for lockdowns globally as well, yeah.
And I guess therefore it's something that when you hear news flow that comes through, as a lot of you know, I'm sitting in London at the moment. You know, the media is awash with different rumours around different aspects of all the three things you mentioned, Andrew. And you know, markets need to absorb it every day, and they do absorb it every day and react accordingly. But actually, no one knows, do they?
That's right. I mean, there's so much uncertainty, and our view is that while there's still this uncertainty, that we've got to be careful of risk. And things could go two ways. It could come out and confirm that the virus is incredibly dangerous and as dangerous or more dangerous than Delta, and the vaccines don't work. If that happens, equity markets and other risk markets will continue selling off like they have been. If it comes out the other way and they say that, look, the vaccine's not dangerous at all, there's basically no hospitalizations, people aren't dying, then that can actually be really positive for markets, because what that will mean is that you basically have this natural vaccine going around the world and vaccinating everyone. Because then I call it a natural vaccine because yes, it's a virus, but in reality, if it's not killing people, it's not putting people in hospital, it's basically just building people's immunities, and that would be positive because that would almost spell the end of major concerns for COVID. Yes, there may be ongoing concerns of other variants, but it would be really positive to basically vaccinate everyone through this natural form of the virus. So yeah, really the outcomes could be either way, but combination with other factors such as tightening with the Fed and what's going on with general risk appetite, it feels the right place to be is more cautious right now.
Great, thanks, Andrew. Thanks for reminding me about the promise of going over our views up on that. Look, we've just had 10 a.m. It's 9 p.m. London. I'm jet lagged and I'm hungry, so I'm going to go and have some dinner and then watch New Zealand markets open. But again, do touch base if you want to talk through anything we've discussed today. Otherwise, look forward to speaking with everyone same time, same place next week. And have a good week, everybody, and thanks very much.
Thanks, Darren.